Welcome, everyone, and thank you for taking time out of your busy day to learn about post-year 15 monitoring procedures. My name is Shauna Higgins, and I'm joined by Crystal White. We are Senior Portfolio Analysts here at Washington State Housing Finance Commission. I've been in affordable housing for the last 13 years and with the Commission for just over a year now.
And I have been in affordable housing for over 12 years and with the Commission for about 4 years.
What is post-year 15 monitoring? Post-year 15 can be thought of as a reward to owners for participating in the program and staying in compliance. With Commission approval, your tax credit property may be offered the ability to have streamlined monitoring procedures year 15 of the property's regulatory agreement. These procedures are designed to both preserve the long-term affordability and lessen reporting burdens for owners. Qualifying for post-year 15 monitoring. Properties must satisfy a qualifying threshold to be eligible for post-year 15 monitoring procedures. Properties must have 3 consecutive years of annual reports and on-site inspections free of material non-compliance as determined by Commission staff. This includes 8823s and state non-compliance. No transfer of ownership, which includes GP transfers and or the sale of partnerships or switch of property management companies in the last 3 years. Approval process. If the property is approaching its 15th year of compliance, the owner will receive a letter of eligibility from us. They're typically mailed in the first part of October. Alternately, you can check the post-year 15 monitoring list on our website to see if your property is eligible to apply. Eligible list from our website. Here is a sample of what the post-year 15 monitoring list on our website looks like. It's updated annually. To calculate when year 15 will occur, let's take 12th Avenue Arcs, for example. Look across the row to the column that's titled First Credit Year. That says 2015. So you're going to add 14 years to that, and you're going to come up with 2029, which should match the year 15 column. Please double check your 8609s, and if the first credit year differs from our records, please contact your portfolio analyst right away. If there's a date in the column named Date Approval for post-year 15 monitoring, this property is already approved. But if your property recently went through a property transfer or management change, this may not be correct, so please check with your portfolio analyst. The approval process. The owner must complete and send in the eligibility request letter and the summary of post-year 15 monitoring procedures with the owner certification. These must arrive at the Commission before November 30th. If your request isn't complete or doesn't arrive at the Commission until after November 30th, we will still review it for reduction in compliance and monitoring procedures, but you will not be eligible for the fee reduction until the second year. Eligibility letter. This letter lets you know your property is eligible. Page 2, it will have to be filled out by the authorized signer, including their phone number and or email address. They need to sign this and date it. Summary of post-year 15 monitoring procedures with owner certification letter. This letter summarizes the post-year 15 streamlined procedure and what is expected with annual report, initial qualifications, recertification, household transfers, common area units, on-site visits, compliance fees, transfer of ownership, record retention, non-compliance. Crystal will go over these more in detail later in the webinar. Authorized signer will have to acknowledge that they read these pages and Chapter 11 of our manual and understand the post-year 15 monitoring procedures and agree with the monitoring requirements. Once approved, the Commission will send the owner a signed approval letter. For 100% affordable properties, this letter will state this property is approved for post-15 monitoring procedures as described in Chapter 11 of the Compliance Procedure Manual. It will also let you know the effective date. Mixed units and tax credit and market rate. For these properties with mixed units, this letter states that since this is not a 100% low-income property, all residents will have to be recertified annually. They cannot transfer to another building without requalifying, and the common area unit cannot be moved without our approval. However, this property is entitled to the reduced fee and less units inspected during an on-site. Certification process. Initial qualifications, owners must continue to income qualify all households upon initial occupancy of an affordable unit. Owners must also continue to adhere to limiting upfront charges and fees. Recertification. If this is a mixed property, meaning tax credit and market units, third party is still required. If it's 100% affordable, self-certifications start after the initial certification. To satisfy the IRS and other funding requirements, the Commission has adopted a self-certification of annual income form. After initial qualification, households may self-certify their income and student status annually on their lease anniversary date. And here's Crystal.
This is a copy of your self-certification. It's a sample. It's 2 pages. This replaces your full third-party verified certification. The first page, you will list anybody that's in the household, their date of birth, and then to satisfy the student portion of the research, they would answer the full-time student status, yes or no. Below that, it goes on to the household member's name, their total gross income and assets, the source of the income, and then the initials of that household member. Followed by that, they're going to sign, print, and date. Each member of the household over 18 would have to do that. The bottom portion of page 2 is to be completed by management. It will include the original move-in date, effective date of that recertification, the total gross income for all household members would be added up and totaled here, the tenant's portion of rent, their utility allowance, the subsidy portion, and then the set-aside at the time of that research. It's then going to be signed, print, and dated by management, and that's important to be filled out. Annual reporting. For the annual reporting for post-year 15, you would go to the website and print out the one that shows post-year 15 and or recert waivers. It would be attached to the checklist 2016 annual reporting or whatever year you're reporting for. It's going to include the annual owner's certification that's printed out, and the original must be sent in, the original owner's signature. Table 1 of W-bars will be submitted. A copy of the utility allowance schedule. You must circle the amounts used within that building, and it should match W-bars. The written explanation or completed extended vacancy rent-ready report should be submitted for all units where they were vacant for over 90 days. An explanation must include the date the units became vacant, when they became rent-ready, and the reason for their extended turn time and or vacancy. Move-in packages and current certification for all households whose income exceed 140% at the first year recertification, and also include the explanation for the increase of their income. That could be just done on a sheet of paper and attached to those certifications, just explaining why there was such a drastic increase. Special needs vacancy report with backup documentation if a special needs commitment elected have not been met. The affirmative marketing report, that's if applicable. To find out if your property needs that or not, you can go to the link on our website. Homeless and transitional report, if applicable. Farm worker move-in report, if applicable. And then where to mail it to. Your portfolio analyst's name and address to send that to would be listed, and then who prepared it and their phone number. Unit transfers. For 100% affordable properties, households may change units even into a different building without the requirement of a new household income qualification. Owners should indicate all household resident transfers on Table 1's report in W-Bar. Common area units. Employees of a property will not necessarily need to be full-time employees at that property to occupy the common area unit, as long as the owners can justify the need for the manager, maintenance, or security person for that property. The employee's principal occupation is to manage the subject property. On-site visits. The Commission will maintain the standard of inspecting units every 3 years. Properties may be inspected more frequently if needed. Generally, the percentage of units inspected will be reduced from 20% to 10%, with a minimum of at least 5 units to be inspected. Compliance fees. For qualifying properties, fees will be reduced $10 per unit per year, as long as the property remains in compliance. For rural development properties, the fee is reduced $100 per property per year. Special needs set-aside. It will allow for switching from transitional to homeless with the Commission's written approval. Changing of other set-asides would require proof of the following. For example, disabled and large households, you would need to provide significant demographic changes and or financial hardship affecting the viability of the property. Additional changes to the low-income set-aside. Owner requests will be considered on a case-by-case basis. The owner must demonstrate financial hardship. Significant supporting data is required, and the change will be coordinated with other funding agencies. Record retention. You need to maintain initial move-in certification records for 6 years from the move-in date. All original files that leased up the property still need to follow the record retention of 21 years. If there is a management or ownership change, the original files should be transferred to the new ownership or management from the prior ownership or management. If the owner is thinking about applying for resyndication, please be sure to keep a qualified third-party verified certification on all residents. Non-compliance. 8823s can still be issued to the property if the non-compliance is discovered after year 15 for certifications in years 1 through 15. State non-compliance letters can be issued if past year 15. For chronic or serious non-compliance, temporary suspension and or debarment procedures may be implemented. Properties with chronic or serious noncompliance will no longer be eligible for post-year 15 monitoring procedures and will be required to complete a new 3-year qualifying period after all noncompliance issues are corrected. Areas of no change. You're still going to be required to document full-time student status and their rules, follow their rules. All special needs and additional low-income set-asides will remain the same, and utility allowance implementation will still need to be implemented. Please take note. Additional low-income use period is still 1 to 22 years, and other funders will have their own guidelines, so be sure to check with them about if they have any different procedures. Can post-year 15 monitoring procedures be revoked? Yes, for the following reasons. chronic and/or serious noncompliance, as previously mentioned, transfers in ownership or general partners or a change in a management company, and resyndication of the property. Except in the case of resyndication, post-year 15 procedures can be reinstated after the property completes a new satisfactory 3-year qualifying period. Thank you so much for listening in on our webinar about post-year 15. If you have any questions or concerns, please contact your portfolio analyst that can be found on our website at wshfc.org. Thank you.